Good morning, everyone. Welcome to the Phillip Securities Research Morning Call for 4th May of 2026. First of all, please be informed that Paul is not here today with us, so we can't really answer some of the questions that are related to his coverages. For today, we have multiple stock counter updates. We have results for the Magnificent Seven companies for the US sector. We also have results for the Singapore stocks companies, for example, like REITs. We have the usual technical analysis, S&P 500, and for the April ETF updates, and also some of the macro outlook update. Yes. This is our usual disclaimer. Please note that the information presented today are taken from the public sources, and please refer to your financial advisors before making any investment decision. For our first presentation is on the Microsoft Corporation. So they released a result last week for the third quarter of 2026. The title as shown is the Another Quarter, Another Capex. So for the result, the third quarter of 2026 revenue met our expectation, while the PATMI exceeded. The 9 months of 2026 revenue and PATMI were at 76% and 81% of our financial year 2026 forecast. You look at the table on the left side, the group revenue grew healthily at 18% year-over-year, 2% ahead of the guidance. The fastest growing business segment is, as usual, is the intelligent cloud. Banking on the Azure revenue accelerated about 40% year-over-year, higher than 33% in the same quarter last year. The more personal computing fell about 1% because of the window and gaming, which fell about 2 and 7% respectively. And then the productivity and business suite grew 17% strongly because of the user growth and the higher ARPU. The operating income grew about 20% year-over-year, and while the PATMI grew about 23% year-over-year strongly, the RPO backlog doubled year-over-year because of the OpenAI commitment. And if you exclude the OpenAI commitment, the RPO grew about 26% year-over-year, still strong nevertheless. Looking at the positive side, the productivity demand stayed strong. The productivity and business process segment was up 17% year-over-year, driven by the 19% growth in the Microsoft 365 commercial cloud revenue. The factors were the ARPU expansion and also the uptake of the higher tier offerings, such as Microsoft 365 Copilot and the E5, which is their enterprise subscription, the most expensive one. If you look at the paid Copilot seats, right, the user interface for the AI products have surpassed 20 million, grew from the 16 million from the previous quarter. So it's a huge jump. Nevertheless, it's still at the 5% of the total paid commercial seats that grew about 6% year-over-year. And then for the second positive point is that on the Microsoft Azure, it continued to climb but higher. The intelligent cloud revenue grew about 30%, banking on the Azure, which grew about 40% year-over-year. And this growth, which outperformed the guidance, was because of the Fairwater data center capacity in Wisconsin, which came online about 6 weeks earlier than scheduled. And another metrics that we're looking at is the AI business related annual run rate. Have exceeded 37 billion, and this is a 123% year-over-year growth. And we expect the Azure to remain slightly margin dilutive in the near term due to the AI build-up, but will turn accretive as the capacity will continue to grow and monetization continue to improve, probably in the 2027. So for now, the margin has eased about 39% and slightly lower than 41% in the same quarter last year because they spent higher on the AI and Copilot usage. For the negative point, we have that sharp increase in the capital expenditure. The company increased the capital expenditure by 40 billion US dollar to 190 billion US dollar for 2026, not financial year of 2026, meaning that it would affect the last quarter of financial year of 2026 next quarter. The increment, part of the increment, the 25 billion US dollar, part of the 40 billion is because of the higher components and higher financial lease that they are about to do. Because of this increase of the capital expenditure, the current annualized property plant and equipment annualized is at 106 billion. That is above of our 83 billion estimate for the financial year of 2026. Because of that, sorry. For the outlook, we expect a higher group revenue at 17% year over year and continue growth coming from ASU, which will grow about 29% year over year for the financial year. This would be supported by the faster ramp up of the additional data center capacity that would come online. We believe that the revenue recognition from the OpenAI related backlog will be materialized meaningfully from 2027, and this would support further growth acceleration. At which for 2027, we believe the revenue would accelerate to 18% year over year, 2% higher. Microsoft is expanding their capacity aggressively, as we see from the news that it does have to take that small confidence. We believe that the demand would continue to exceed the supply and it is expected to remain tight through the year and despite the ongoing capacity expansion. For the productivity business, would grow about 15% year over year because of the July 2026 subscription price hike increase and the new E7 enterprise package, which include Copilot. We believe that the continued features upgrade in the Microsoft 365 and Copilot should support usage and mitigate competitive pressure and potential demand softness. With commercial seats, it currently has exceeded 450 million, 6% year over year growth. We also believe that for next year, financial year of 2026, PATMI is now would grow about 22% year over year, higher than the 14% that we estimated earlier. Regardless, our view is that we believe that Cloud Azure cash flow from operation will remain sufficient to pay off the capital expenditure for the year after the capex raise. Which is about 171 billion for the operating cash flow, which is higher than 121 billion of PPE addition for the year. Group revenue may see higher growth for next year, increase to 17%, accelerate about 2% from the current financial year. Lastly, for the valuation, we downgrade our recommendation to accumulate from buy with a lower target price of 485 due to the higher capital expenditure. We raise our property plant and equipment estimates to 121 billion from previously 83 billion US dollar. And we also raise our revenue forecast by 3% and 5% for the financial year 2026 and 2027 and PATMI by 9% and 17% because we believe that there would be a step up in growth as new data center capacity comes online, especially after the huge capital expenditure. That is all from me. I will pass over to Serena for the Alphabet presentation. Thank you.
Thanks, Fahmi. Good morning, everyone. Let's start with Alphabet first, in which I title Full Stack Advantage Delivers. Next slide, please. So the first quarter 26 earning actually below our expectation. The revenue up 22% to 109 billion. This is driven by a strong ad and cloud performance. But adjusted PATMI actually declined 28% to 24.9 billion because of the massive AI spending. So the first quarter 26 revenue PATMI was at 23% and 16% of our financial year 26 forecast. So moving to the positive, which is more segment focus. For Google ad business, the advertising revenue actually grew 19% year on year to $60.4 billion. And YouTube ads revenue also up 11% to $9.9 billion. So at the moment, the queries are now at an all-time high because of the AI experience in AI overview and AI mode. And the company also continued to deploy Gemini model. So it's now expand across the Alphabet ad infrastructure in order to improve the ad efficiency. They have a better understanding of the user intent. So for this business segment, we actually keep the financial year 26 forecast unchanged. We expect a revenue growth of 16% year on year. This is supported by the stronger user engagement and also improving monetization opportunity from the deeper Gemini integration across search, particularly we are more focusing on AI modes, and alongside with there will be a long-term, we do see a long-term potential for the ad placement in the Gemini app. And moving on to the cloud segment, it continued to show a very strong momentum. The revenue accelerated 63% year on year in the first quarter to $20 billion. And the operating income also grew like 3 times to $6.6 billion. This is led mostly by a very robust demand for enterprise AI solution. The resilient performance was also driven by 3 main points. The first thing that is the accelerating customer acquisition, and the second one is a very strong deal momentum, and the third one will be expanding the client spend. So at the moment, the backlog is now reaching $462 billion. And the company mentions that they do expect a 50% revenue realization over the next 24 months. So we think that it kind of indicate that cloud revenue will reach well over $230 billion in the first quarter of 28. So we increased our revenue forecast 1%, and we now do expect Google Cloud segment to grow year on year because of robust cloud demand. And also, we do see a gradual conversion of backlog into a revenue recognition. And the third positive will be they are stronger operating leverage. The operating margin actually increased 220 basis point to 36.1%. This is led by 300 basis point expansion in Google services to margin around like 45.3%, and also cloud margin also rose very significantly to 32.8% from 17.8%. So the efficiency gain was actually supported by a strong revenue growth. And the second one is the process innovation. So we do expect the operating margin to improve over time because we do see Alphabet to continue to leverage the integrated AI stack, and they will continue to expand the technology infrastructure. So they will be driving a greater cost efficiency in model deployment, and therefore they will be able to have a more stable and long-term profitability. But moving to the negative, for all the hyperscaler, they moving on, they are expecting a higher capex for financial year 26. I mean, same for Alphabet. The capex actually grew 108% to $35.7 billion in this quarter. Most of the money actually spent directly to the AI infrastructure like servers and data center. And the free cash flow also declined around like 47% year on year to $10.1 billion because of this heavy AI spending, front-loaded infrastructure spend. And in terms of the guidance, the company increased the guidance by 3%, capex guidance by 3%. So now they're expecting a capex spending around like $180 billion to $190 billion. This is to support the robust demand for the AI compute resources, and they continue to signal a very significant increase of capex moving to financial year 27. But all of this, we see this as a temporary liquidity squeeze, but we think it's necessarily for them to secure the AI capacity. Of course, it will have some weight on valuation, but we think that the impact could be offset considering there are still a very strong performance in the core advertising and cloud business segment, even though there might be a dampening short-term cash flow growth. So for Alphabet, we maintain an accumulate rating, but we raised our target price to $450 US. This is driven by the Alphabet, a very differentiated full stack AI capabilities. We also increased our forecast revenue by 4% and PATMI around like 6%. This is because we do see a higher than expected momentum from the AI ecosystem, coming from the customs silicons to the very high performing Gemini model. We also do see a very robust demand both internal and external demand. So we think that it will be beneficial to boost the ad and cloud segment. Yeah. Next, moving to Meta. Next slide, please. Thanks. We titled higher capex raised concern about monetization plan. So next slide, please. For the result, the first quarter result earnings actually below our expectation as well, but the revenue actually up 33% year on year to 56.3 billion, and the adjusted PATMI increased 13% year on year to $18.7 billion. So both of the revenue and PATMI were at 21% of our financial year 26 forecast. So Meta delivered a very robust advertising performance in the first quarter because the ad revenue actually reaching $55 billion is up 33%. This is driven by a very strong user engagement and also improved monetization. And another part of the reason of this improvement is actually supported by the integration of MuseSpark. This is Meta newly launched the multi-model reasoning model. It's the first model actually launched by Meta Super Intelligent Lab. It helps to enhance the content personalization and also recommendation capabilities across the platform. So since the deployment, the company sees a 19% year-on-year increase in ad impression and also 12% year-on-year increase in the average price per ad. So this is why we continue to see a strong monetization power. So given the very strong, since this is a very new model, given the very strong early traction, and we do see that there's a potential to scale the model across the platform, including like WhatsApp, Instagram, Messenger, we actually maintain our financial year 26 advertising forecast. We continue to expect Meta to deliver a 30% year-on-year revenue growth in the ad business segment. But of course, moving to the negative, the non-core reality lab segment remains unprofitable, but the operating losses continue to narrow. So now it's narrowed around like 4% year-on-year to $4.2 billion. The segment revenue declined around like 2% to $885 million. Mainly it's because of the lower Quest headset sales, but in terms of the AI glasses, the company continued to see that it performed quite well because the daily user is now growing at 3 times year-on-year basis. And of course, the most discussed topic is about the capex. I mean, in first quarter, Meta capex actually grew 45% year-on-year to $19.8 billion. Majority of the spending actually spending directly to a data center, servers, and network infrastructure. So the company actually raised the capex guidance by 8% to a range of 125 billion to 145 billion. This is because they do see a higher component cost, particularly focusing on memory pricing. And the second one is there will be an additional data center cost to support the future capacity. So of course that the capex is expected to weigh on the valuation in the short term because of the higher infrastructure cost and talent compensation, because in this quarter that it actually rose like 35% year-on-year. So for outlook, Meta issue a total revenue of $58 billion to $61 billion in the second quarter. It implies around like 22% to 28% year-on-year growth. Of course, I mean, for the expenses, they remain the forecast unchanged to in the range around 162 billion to 169 billions. At the moment, we do believe that the fundamental remains intact, but we do see on the short-term basis, there are two factors that might have some pressure on the share price. The first one is definitely the rising AI the capebacks. We will continue to see it becoming a drag on the near-term share price because unlike the very diversified peers, Meta revenue stream is more focusing on advertising. It will be much harder for them to offset infrastructure costs and to also monetize the excess capacity like Alphabet does. So it might leave the company to have more exposure to a margin compression. But over the long-term basis, we actually want to expect we actually will expect a greater visibility on the monetization roadmap. We will be more focusing on agentic commerce initiative in order to justify the current level of spending. And the second part of it will be the ongoing youth safety cases. We do see that it remains a potential headwind to a share price, even though Meta continues to appeal the case, because this ruling, even though there's no immediate impact at the moment, it could potentially set a precedence for the recurring liability because of all the fine and all the fine. So I mean, at the moment, we still believe the material impact, it really depends on if there is any structural changes to the platform features or core business practice by the regulators. I mean, for Meta, we upgrade to a buy rating because of the recent share price performance, but we actually reduce the DCF target price to $795. We keep the revenue unchanged, but we reduce the PATMI forecast by 7% because of the higher than expected expenses and also margin compression. We remain highly constructive on the long-term potential of MuseBar, which we expect to continue to drive robust advertising revenue growth. Yeah, and that's all from me. I'll pass the time to Helena. Thanks very much.
Thank you, Serena. So I'm going to talk about the next hyperscaler, which is Amazon. So for Amazon, their first quarter revenue was in line with expectation. When it comes to their PATMI, there is 16.8 billion pre-tax gain from their Anthropic investment. So if we take that out, they actually underperform because they have higher than previous tax expenses. So overall revenue and adjusted PATMI were at 23 and 18% of our forecast. AWS growth is phenomenal. They re-accelerated further, have very strong AI-driven demand. It grew 28% year-on-year, which is their fastest growing speed in 15 quarters. This is driven by both the core cloud migration and also the expanding AI workload. So their Bedrock continues to gain traction. It grew 180% quarter-on-quarter growth in customer spending. So that reflects a very strong customer adoption. Demand visibility, very strong. Backlog grew 93% year-on-year, and that is not including their Anthropic deal. So if you include it, it's more than 100. Management reillustrated that they're continue going to spend heavily on capex, but they didn't raise their capex guidance, so it's still $200 billion for the entire FY26. But they're saying they have very high confidence in the monetization, given that a very substantial portion of the capacity is actually already backed up by customer commitment. Their operating margin declined 180 BPS due to the elevated capex. And the second point, which is what we think is becoming more of a structural advantage, is their customer silicons. So their in-house chip scaled rapidly. It grew 40% quarter-on-quarter. So they are now one of the top 3 data center chips business globally. Their training chips deliver 30 to 40% better price performance versus other alternatives, and they're currently largely all sold out. Or even their next generation, they already have strong multi-year commitment from major AI labs. And they also mentioned that their own customer silicons, they're also using very heavily for their own Bedrock. And all this can save tens of billions in capex annually and provide several hundred basis points of margin advantage. So that also reinforces its role as a key differentiator. And we think this vertical integration strengthens their cost structure and pricing power, particularly as the AI workload scale. On the retail side, they're still trying to focus on fulfillment efficiency, which is driving their operating leverage. Their unit growth was around 15% year-on-year, but their cost growth was much lower. The outbound shipping cost only grew 12%, and fulfillment expense only grew 9% year-on-year. So it's outpacing the cost growth. They're focusing a lot on fast delivery, especially the perishable. So their perishable sales have scaled over 40x year-on-year, and now driving higher engagement, because once you start buying groceries on it, you will also buy a lot of other daily product on the same time. And right now, Amazon is already number 2 biggest grocer in the US. And they've calculated that so for people who buy everyday perishables, they will usually order nearly 3 times more items, and they will spend more than 80% more than the average person who doesn't shop groceries online. So all these are helping them to gain more market share, especially winning people who doesn't usually shop online. Now these people are shopping online as well. The only negative thing that we're seeing is because they're spending so much on capex, their free cash flow is definitely under pressure. It declined 95% year-on-year due to the ramp up in AI spending. And these investments, of course, they're aiming to capture long-term growth, but definitely waiting on the short term. We do expect their FY26 free cash flow to be slightly negative because of this. In terms of guidance, they've guided the second quarter revenue to be 16 to 19% year-on-year growth. We think currently Amazon is positioning pretty well in the AI value chain. They have a full stack capability. They have cloud. They're also trying to do customer silicons. And now they're deepening their partnership with leading AI players like OpenAI and Anthropic. And now now OpenAI model is coming onto AWS as well. So that also helps narrowing their gap with Microsoft earlier, and that further accelerate their adoption of Bedrock. And that alongside with their uptake of their customer silicons, it definitely strengthens their entire AWS ecosystem stickiness. In terms of valuation, we didn't change our valuation, but we actually downgrade our recommendation from buy to accumulate. But this is purely because of the recent share price movement. Our target price is still $280. Okay, moving on to the next company, which is Spotify. So Spotify also released their earnings last week. Their first quarter revenue grew 8%, which is within expectation. Their PAMI exceeded our estimate and jumped 220% year on year. This is driven by a 49 million benefit from the social charges. Their first quarter revenue and PAMI were at 23 and 30% of our forecast. We're seeing very strong top line growth. User momentum is still intact. MAU reached 761 million. That's 12% year on year, which is exceeding their own guidance by 2 million. The growth was led by rest of the world and mainly North America, supported by their enhanced free tier rollout, which improved engagement. And now they're seeing users listening and watching more days per month, which they think is a very key driver of retention and lifetime value. So that kind of shows their broader monetization framework. Margin continued to expand. Their margin has been expanding for multi-years already. This time it expanded further 130 BPS year on year, supported by their premium ARPU expansion, which grew 5.7% year on year, and a very disciplined cost management. They illustrated their full year margin to expand in FY26 despite their near-term reinvestment in AI and product initiatives. So that highlights the confidence for them to sustain operating leverage as the business scales. The second point, which we think is very important, is now everything is AI-driven personalization. It's accelerating engagement and reinforcing long-term monetization. They're deepening its AI capability. They're coming up with new features like AI DJ. AI DJ now already have 94 million users out of their entire 290 million subscribers. And they have new launches like Song DNA, which they just launched in 4 weeks' time. It already reached 52 million users. So very rapid adoption. They're enabling faster product iteration and lower cost per feature and much, much deeper personalization. We're seeing Spotify really evolving from just a music app to a data powerhouse because they have a huge amount of user base, and the data that they have has been building for a very long time, the listening data. So this helps them to create a very highly granular taste profile that is very difficult for their competitors to replicate. And it's not something that you can easily just buy the data from online. So this is a big structural advantage for them. But moving on to the negative, their advertisement sector is actually pretty weak, and the growth is more skewed towards the lower quality users. So yes, they do have very strong engagement, which is particularly driven by its enhanced free tier rollout, but it has yet to translate into monetization. Their ad-supported revenue only grew 3% year on year, and that is under constant FX. So very weak monetization despite a high usage. So there was like a gap between the people using it and the gap actually making money. Their premium subscriber growth very modest. It only grew 3 million in the quarter, and the next quarter guidance was they're going to grow 6 million. So compared to last year, it was rather muted. So it also suggests the widening gap between user growth and monetization efficiency. But management did comment on that. They do see that problem, and they actually realize there has been structural shift towards more pragmatic and biddable buying when it comes to advertisement. So they have spent 1.5 years rebuilding the entire advertisement tech stack. So they believe that as time goes by and their new ad stack will start rolling out, it's going to shorten the gap. Another negative that we see is, of course, near-term margin pressure, especially when they're investing more in AI and product rollout. They've guided the operating income of 630 million, which imply a quote-unquote decline because of the AI related spending. In terms of guidance, they've guided 14% year-on-year growth in revenue, driven by user growth. MAU will continue to grow around 12% year-on-year, and they expected the ad growth to come in the second half of the year as their billable channels continue to scale. We think overall, very strong user momentum, improved structural profitability. When it comes to monetization, yes, there is a gap, and there's also near-term margin pressure, but it is like a structural evolution of the company, and the reinvestment phase is especially important for them because right now their core advantage is their impeccable and very unique data set that is very dynamic and very hard for people to replicate. So they really need the right ad tech infrastructure and AI capabilities in order to really utilize on their strengths. So we're still pretty positive on the company. We remain unchanged in our valuations, and we maintain our buying recommendation with unchanged target price of $650. That's all from me. I'll pass my time to my colleagues.
Yeah, about first REIT. Yeah, so for first REIT, portfolio reconstitution. Sorry, can you go back to the previous slide, the title? Yeah, so portfolio reconstitution progresses mainly from the fact that they're going to sell their Indonesian assets, and after they're going to look for acquisition opportunities in developed markets. Yeah, next slide, please. Yeah, so for the first quarter 2026 business update, so their performance, as usual, is impacted by the stronger SGD against the Indonesian rupiah as well as the Japanese yen, as well as but this time it was slightly impacted by the divestment of the hotel and country club as well that they divested last year. Yeah, so overall DPU on a year-on-year basis, it's down 14%, but quarter-on-quarter is down about 4%. So previous quarter the DPU was 0.52 cents. So now it's 0.5 cents. Yeah, so for the positives for this quarter is that the operating performance in local currency terms has been stable for the longest time. So because of their base rental escalation, 4.5%, and some of performance-based rent. So for their first quarter, their income from Indonesia is up 4.7% in local currency terms. So Singapore is up 2%, Japan stable. Yeah, and for capital management, their gearing it rose because of they drew down on some RCF to pay off the perpetual that they redeem in full. So they do not have any perpetual bonds remaining. Their ICR is also healthy, so their cost of debt also declined. And yeah, with 44.2% hedge. So for them, right now they still have about 6.6 million that's outstanding of rental in arrears from MPU. So the full recovery of this 6.6 million is dependent, or rather is connected to the divestment of the first tranche of the Indonesia hospitals. So once that goes through, then the rental in arrears will be repaid in full. Yeah, so for the rest of the portfolio, they have minimal exposure to high utility costs because most of these are fully borne by the tenants in Singapore and Japan as well. Yeah, and they're like I mentioned, they're pending the divestment of the Indonesian portfolio. So looking to divest that, completely exit from Indonesia. And right now they are still undergoing their strategic review, the part 2. So part 1 was the divestment, and now part 2 they are looking at potential acquisitions. So what we'll use the proceeds from the divestment to invest in. So they're looking at more developed markets. But we do note that if they're looking at developed markets, the yield will likely decline because now they are paying like 9%, 8-9% dividend yield. Developed markets, the MPI yield is not so high, usually around 4 to 6 or 4 to 7% rather. So the dividend yield is expected to decline. So we are monitoring to see what they will acquire. So that is still to be confirmed. Yeah, so there are no updates on the front. So for now, we still maintain our target price 25 cents. So this currently our target price is basically based on the FY 2025 one times price to NAV, because basically after their divestment, they will not have that basically there will be an income vacuum. So we also do not know what they are going to invest in or acquire. So we just keep it at one times price to NAV for their target price. Yeah, next slide, please. Yeah, so for Stoneweg, rental indexation to drive organic growth. So that's basically from the most of their leases are tied to CPI or some form of a rent inflation indexed. So they'll benefit from higher inflation. Yeah, next slide, please. Yeah, so for their results, it was in line with expectations. Revenue was down slightly. That's mainly because of asset divestments that were completed in 2025. So they did redeploy some of these proceeds into some acquisitions, but they didn't contribute in the first quarter. So going forward, the revenue is expected the decline will kind of become lesser or maybe even growth. And for DPU wise, it's up 1.5%. That's mainly from the fact that they bought back some securities, 2.1 million in units they bought back year to date 2026. So that's why DPU was up about 1.5%. So they guided for stable DPU in 2026. Yeah, so for their positives is that their operating performance remains relatively resilient. So 93% occupied. So the light industrial and logistics assets, they're still the star performer, 95.1%, expected to remain around these levels for the rest of the year. The office portfolio is 86.8%, with some slight negative reversions as they try to focus on securing or keeping occupancy up at the cost of rents. But for this, some of their weaker assets, like for example in Poland, they are still, despite it only being like 70% occupied, they are still getting an MPI yield of about 7%. So that's still quite attractive. So they are basically in no real rush to divest those non-core assets as they are still paying a decent yield. Yeah, the light industrial logistics had a 7.6% rent reversion. That's very strong. So possibly we're expecting it to remain around that levels for this year. Yeah, so for their cost of debt also is 3.86. We expect it to remain below 4% despite the potential rate hikes in Europe. So they have 87% of their debt hedged. So their gearing 42.7%, net gearing, so likely to decline going forward as they use some of the divestment proceeds to pay down debt as well. And so for the outlook, their rental indexation to drive organic growth. So most of their leases, they will it's on a yearly escalation based on CPI rental indexation. So they benefit almost, or rather, there is a slight delay, but it's like less than 1 year delay. So that is positive. We also expect some long-term NAV upside potential from their stake in Ionics. So Ionics is their sponsors data center development platform. So right now they have a 6.6% equity stake. And just last Monday, or rather 2 months ago, they invested another 50 million euros into Ionics via a 7.25 coupon mandatory convertible loan. So this MCL, after 7 years, it will be converted into equity at a significant discount. So there's more upside potential there. As well as the original 6.6% equity stake that saw a 40% upside or valuation upside in 2025 alone. Yeah, and for their portfolio constitution, they are looking to raise their DC exposure to around 15 to 25% by FY 2028. So how they're going to do this is possibly by divesting some of their non-core assets or even converting some of their logistics facilities into data centers, as well as possibly increasing their stake in Ionics as well. So they're looking to expand their DC exposure. So yeah, no change to our target price. And right now, Stoneweg is while waiting for the capital upside from the NAV growth, they're still paying a very solid DPU yield of 8.7% at the current price. Yeah, so it's in our books, it's very attractive. Yeah, next slide, please. Yeah, so the next slide we have is CLAS. So for CapitaLand Ascott Trust, they are more resilient because of they have a big portion of their income from stable income sources. Next slide, please. So there's like the living sector, PBSA, and management contracts on minimum guaranteed income. Yeah, so very little details were given in their first Q business update. So DI was stable year on year. So but that's mainly because they use slightly under 10 million of divestment gains to top up because of the loss of income contribution from the Cavendish London that's undergoing AEI. So they already guided that, so there's no surprise. So going forward, they also guided stable dividends. So we are looking at a yield of about 6.8% at current price. Yeah, so for the positives is that the same store RevPAR growth grew 1% year on year. So that's different from the reported RevPAR, which is seen in the table in the middle. So that's down -3%. But same store, if you exclude acquisitions, divestments, and properties undergoing AEI, it's about 1%. So all the properties are all the geographies were up on a same store basis. And previous few quarters, we saw some weakness in PBSA, US PBSA, in the previous academic year, like 2025, 2026. That's mainly from increase in supply in some of the markets. But going forward for the next year, there is an improvement. So right now, it's already 80% pre-lease. So the next academic year starts in August. Yeah, so numbers are looking good, and we are expecting some revenue growth from in the next academic year for the US PBSAs. Yeah, and for this particular quarter, so their borrowing costs continued to decline. So now it's at 2.8%. So with 78% hedge, we're looking at the cost of that to remain relatively stable for this year at 2.8%. So that's very low. And gearing is also healthy. Yeah, so for the outlook wise, we are looking at low single digit RevPAR growth expected. So that's supported by the US portfolio. So that's because there's a World Cup upcoming. So that's a huge boost to the US portfolio. So you do expect at least a low single digit or portfolio growth as a whole. And because of the war in the Middle East conflict and which drove higher airfares as well. So there is a moderation in international travel. They're still monitoring the situation, but we think that going forward, this moderation in international travel could partially be offset by regional and domestic demand. Yeah, and for OpEx or higher utility costs or electricity prices, energy prices, they do have limited exposure as most of these costs is either passed on to tenants or the either passed down to tenants or they've already hedged a big portion of it until end 2026. Yeah, so the electricity costs account for about 4% of OpEx, so they do have limited exposure. Yep, so no change in our TP, $1.08. Yeah, but we maintain our buy call as well. Yeah, attractive yield of 6.8%. Next slide, please. Yeah, so for CLI, their star performer is the fee income, so continues to drive growth. Next slide, please. Yeah, so their first quarter results broadly in line with our estimates. Fee income is up 10%. So that's driven by the REIT management and as well as the private funds management. REID was down slightly because of the divestment of the Synergy platform and weaker operating conditions in China as well. Yeah, so the fee income for the first quarter up 10%, the REIT management up 14%. But going forward, because of like the CICT, their proposed acquisition of Paragon as well as the divestment of Asia Square Tower 2. So that is going to accelerate their event-driven fees. So they're expecting about 51 million in event-driven fees from that transaction alone. So in the rest of the year, we are expecting some these event-driven fees under the listed funds management to accelerate. And for the private funds management also, it grew 58%. They also secured a 2.4 billion mandate to manage the income insurance Singapore's portfolio. So that is income insurance and it's not an NTUC income. And for the lodging management segment, they do expect to open over 25 properties this year. So that will likely drive the lodging fee management growth as well over the next 12 months or so. So for this particular quarter, the lodging management was flat, but the recurring lodging management fees grew 5% year on year this quarter. Yeah, and like I mentioned, so the China's operating conditions remain challenging. So the goal is still to maintain occupancy at the expense of rents. So for business parks, still looking at double-digit negative, and for retail is improving slightly, but we are still looking at negative reversions. Yeah, so because of the Middle East conflict, basically the fundraising and deployment is expected to slow from the strong first quarter. So year to date, they raised 2.5 billion in equity and as well as 7.2 billion deployed. So that's quite strong numbers, but we expect that to slow. And we are looking at a second C-REIT to be launched in the next few months, possibly in this quarter. So that will support capital recycling as well. And yeah, their balance sheet remains strong. So they have 6.8 billion in debt headroom before net debt to equity reaches 0.9 times. So they do have some dry powder to pursue accretive growth opportunities. Yeah, so no change to our TP and buy call. Yeah, next slide, please. Yeah, so next we'll do a quick view on the ground on Maple Street Industrial Trust. Yeah, so for Maple Street Industrial Trust, DP was down 6.3%. That's from non-renewals and higher vacancies in the US data center, as well as FX headwinds and divestments in Singapore. So if you look at portfolio valuations, it's down almost 60 million, excluding FX. So if you include FX, it's almost 300 million. 233 million from lower from the translation. Yeah, but overall as a whole, the whole portfolio is down 9.1%. Yeah, Singapore on the same store basis is up 0.5%. Yeah, so for their occupancy wise, the North American portfolio or the US data center portfolio also continues to decline as there are some non-renewals. Like 4.7% of their leases they've already is non-renewal. So we do expect that occupancy to decline further from the 86.1%. Yeah, but they did manage to resign some leases, and that was at a 3% rent reversion. Singapore rent reversion remains healthy at 6.2%. Yeah, and for divestments wise, for this financial year or previous financial year, they sold 550 million at premium to book value. And going forward for the next financial year, they are targeting about 500 million in divestments in the North American portfolio as well. So they are looking to divest some of the weaker US assets and redeploy into higher quality data centers. Yeah, and we do expect some extended vacancies in the USDC, so we do expect occupancy to decline as well. And for interest costs, we do expect the interest rates to increase because in FY25 it was 2.2%, and some of the low cost hedges are expired, and there's upcoming another 600 million that are expiring. So we do expect the interest cost to increase to about 2.4%. Yeah, they paid a trailing yield of about 6.4%. So for Mint, our overall view is to wait and see as they reconstitute their portfolio, like divest some of the weaker assets and redeploy into higher quality data centers. So we think if you have not invested, we think you should wait to monitor their progress and their execution of this reconstitution plan. Yeah, that's all for me. I hand over time to Hashim. Thanks.
Yep, thanks. So I'll go through CDL Hospitality Trust, Phillip on the ground. So CDL Hospitality Trust owns 22 properties across 8 countries, mainly in hotel, but also in resorts, malls, built to rent, and PBSA, so student accommodation. Majority of their portfolio is in Singapore as well as in Europe. And the latest news from them, they raised 250 million in perpetual securities to retire their higher cost borrowings. Their latest financials, gross revenue is up 5.9%. NPI for Singapore also up 5.9%, mainly from the strong events calendar. New Zealand NPI was up close to 45%. That was because of the contribution from Grand Millennium Auckland. And for Australia, AEI increased over 150%. That's the contribution from Ibis Perth after their renovation, as well as due to an active events calendar. Japan NPI was down close to 10%, and that is due to the ongoing Japan-China tensions. So there is a lot of Chinese tourists who visit Japan, and due to the ongoing tensions, tourist arrivals have fallen close to 50%, and that has affected their Japan property. For Maldives, their NPI is down close to 26%, and that's because of the US-Iran war. Maldives mainly got tourists from the Middle Eastern carriers, and because of the current conflict, that has disrupted the Middle Eastern carrier flow that they have been getting. So they have an interest coverage ratio of about 2.4x, very healthy, and their all-in cost of debt is about 2.8%. For the outlook for the Singapore market, there has been some corporate cancellation, but nothing material. Renovation-wise, M Hotel as well as Copthorne Kings Hotel will be going through a renovation. And new supply-wise, Moxie, which is 475 keys, operations is expected next year, first half 27. For the utilities costs, costs are fixed for 2026, and for 2027 to 2031, the costs are actually locked in at a lower rate. For New Zealand, there is some near-term headwind for their Grand Millennium Auckland hotel from the lower Middle Eastern aircrew business. New Zealand also opened the NZICC Convention Centre in February 26, and they will also be opening one of the largest infrastructure projects, which is their City Rail Link, in the second half of 2026, and this is expected to support their New Zealand hotel business. New Zealand is also trialing new China visa-free visitor travel, which would also be an additional tailwind for the New Zealand properties. Australia is expected to also do well. Demand is outpacing supply, and it also has increased flight connectivity. More flights are choosing to fly from Australia, and they're also increasing frequency. So you have your Cathay Pacific, Sri Lankan Airlines, all are increasing the new routes as well as increased frequency of flights. For Japan, we are expecting a softer 2026 for Far East, mainly because China arrivals are down close to 50%, and JTB, the tourism board, is forecasting about 3% year-on-year drop in overall tourist arrivals for 2026. For Maldives, we are expecting a higher utility cost because unlike other markets, utility costs is not in a fixed price contract, and so any increase directly flows through their OPEX. And there is also an increase in supply of resorts around Maldives that's adding additional pressure on their Maldives portfolio. For UK, we do expect some increase in OPEX from the national living wage increase. So that is where they are increasing the cost of wages by close to high single digits, and that will increase the cost of the hotel property, because there is a majority of their workforce is transient workforce, and that adds on to their total OPEX. So CDL Hospitality is trading at a price to NAV of 0.6 times with a distribution yield of 5.7%. So next, I will go through Far East Hospitality Trust. Phillip on the ground. Next slide. Next slide. So Far East, it operates about 10 assets in Singapore. 9 is in Singapore. 10 assets overall. 9 is in Singapore. 1 is in Japan. And the major markets for their visitors includes North Asia, Southeast Asia, and Europe. So in terms of revenue mix, majority of their revenue comes from leisure travelers. So 3/4, and 1/4 is from corporate travelers. And they're trying to ramp up their non-room revenue by introducing new F&B concepts like the Singapore Martini Club as well as RU. In terms of their latest financials, their gross revenue is up close to 11%, and that's because of the contribution from 4 Points Sheraton Nagoya, which they acquired in 2025. Their financing costs have fallen close to 30%. That's because of the overall lower interest cost of debt, as well as debt refinancing. And as a result, their distributable income is up close to 12%. Their interest coverage ratio is very healthy, covering up to 4 times, with one of the lowest leverage at 33%. Outlook-wise, for Singapore Hotel, their average daily rate fell 3.9% to $165, even though occupancy has increased. So this is because of them prioritizing filling up rooms instead of charging higher prices. For second quarter, we are expecting a conservative performance with some moderate rate increase. For their service residence segment, demand was soft in 1Q, and the revenue mix is shifting to leisure. So currently, corporate segment makes up about 52% of service residence revenue, mainly from banking and finance, manufacturing, and services. And then 4 points, Sheraton Nagoya. It will continue to benefit from aircrew as well as wholesale bookings. And lastly, Orchard Rendezvous Hotel. It has a lease of 37 years, which is quite low. And the REIT hasn't informed of any redevelopment plan. So we are monitoring this because the lease decay accelerates closer to lease expiry. And yeah, the utility cost is fixed till 2029, so that secures their cost, any potential cost increase. So it's trading at a price to NAV of 0.66 times and attractive distribution yield of 8%. So with that, I'll pass on to the next speaker.
Yeah, thanks, Hashim. Next slide, please. Yeah, so quick updates on last week FOMC meeting. So the key outcome was that the Fed keep the rate unchanged at 3.5% to 3.75%, which were largely expected by the market. So there are three key takeaways. First, the committee voted 8-4 to keep the rate unchanged, with Governor Stephen Mearen's supporting a 25 bps rate cut. Well, there are three regional Fed officials supported holding rates unchanged, but opposed including any easing bias in the statement. So in response, the US Treasury yield closed higher last week as markets scaled back easing expectations and reinforce a higher for longer rate outlook. Second, sticky inflations remain the main reason that the Fed is staying on hold. So Powell noted that both headlines and core inflations move higher, mainly due to rising energy price and tariff-related good inflations. So while labor demand has softened, the broader economy remains relatively stable. So for now, Fed see holding rates steady as most prudent approach until there's greater clarities on durations of geopolitical disruptions and its economic fallout. Third, Powell will say the Department of Justice has assured that its investigations will not be reopened unless there's a criminal referral from the Fed Inspector General. So he will still remains at Board of Governors until this investigation is well and truly over. So in terms of outlook, we continue to expect the Fed to keep rates on hold through year end as we think sticky inflations, oil price uncertainties, and geopolitical risks keep the bar for rate cuts relatively high. So at the same time, the Fed is not signaling any urgency to hike further. So for now, the Feds appear to stay patient and watching how these risks evolve. So moving forward, the market will be more focusing on Kevin Walsh, with the net confirmation expected in mid of May. So if confirmed, he could take over before June FOMC meeting. So based on his recent hearing, Walsh appeared to have different view on how inflation should be assessed. So under Powell, the Fed had generally relies on a broad set of inflation measures, while staying cautious around persistent price pressures, even when some of them are come from energy or external shock. So Walsh, based on his recent comments, he appears more focusing on distinguishing broader underlying inflations from temporarily price spike. So he is less emphasized on one-off shock like oil or tariff when assessing inflations. So if this adopted, this approach will likely show softer underlying inflations, which strengthening the case for eventually policy easing. So yeah, I hope this answer. There's one question from Q&A on how the Feds will look different under Walsh compared to Powell era. So yeah, just to add on, Walsh is also consider massive Fed balance sheets to be unhelpful to dual mandates and set to decrease the balance sheet. So for now, we will say the near-term Fed path is still remain uncertain until we can gain more clarity on his inflation approach and broader policy stance. But Walsh also made clear that he support the Fed's dual mandate, so the core policy objectives are unlikely to change. So we also do not expect any immediate policy shift, as any change in policy directions will still require broader community support. Yeah, that's all from me. I will hand it over to my colleague.
Thanks, Zee, for morning everyone. I'll move on to the technicals. Yeah, so first out, the S&P 500 last week we saw a fifth consecutive week of gains. So last week, it was up 0.9% on a weekly basis, hitting new all-time highs on Friday. So I think we are still likely to see this bullish momentum continue for now. Resistance for now likely to be at 7,270 to 7,380 area, which was the Friday highs, as well as the 7,380 will be current upper Bollinger Band level, so closer to key trendline resistance. And in terms of support, I think it's likely to be at 7,145 to 7,200, which is the recent horizontal resistance breakout area, as well as the 10 SMA. Next slide. And next one for ETF money for April, we think S&P 500 and Bitcoin are likely to outperform in May. So in terms of the April performance for the ETFs, it was quite mixed. Top gainers were those tracking Bitcoin as well as S&P 500, which was up 12.5% and 10.5% respectively. Top loser was the ETF tracking oil, SOP, which was down 1.9% after 3 strong months of gains. In terms of our outlook for May, we think most of these ETFs could remain in a bit of a range consolidation. And the ETF tracking S&P 500 and Bitcoin are likely to outperform. With the exception of ETF tracking gold, GLDM, we think the price is expected to extend its weakness going into this month. So that's all from me. I'll hand over time to Glenn for DBS results.
Hey, thanks, Zane. Yeah, so just go through DBS's results. I guess saving the best for the last. Next slide, please. Yeah, so for DBS, we look at their first quarter earnings. They were the first bank, Singapore bank, to release their results. It came in within our estimates, about 26% of our forecast. DPS or dividends were raised as expected, up to 81 cents. So it's 8% year-on-year increase. So this includes the 15-cent capital return dividend. So the base dividend is 66 cents. We still are estimating that the FY26 total DPS will come in at around $3.30. So that means that we are expecting them to continue with that ordinary step-up dividend of 6 cents per quarter for the next year, for one more year. Key highlights, for the results, the data has been out for quite a while, so I won't go too much on this, but basically, net interest income has continued to fall mainly from the margin compression. But if you look at the quarter-on-quarter basis for the margins wise, it was only down 4 basis points quarter-on-quarter. So that's some good news there. We are seeing some normalization of their margins. The one that really moved the earnings and was the fee income, which rose by 16% year-on-year. So this was really from the wealth management fees, which was up by 25%. The specific provisions also normalized. It was only at 14 basis points compared to 36 basis points the last quarter in the fourth quarter. I think the main point for the outlook, right, and that's really what was the talk, was that they have upgraded, or at least very slightly and subtly upgraded their FY26 guidance. The main difference being that they are now expecting that total income will come in around 2025 levels. So they didn't really give any guidance on the PATMI, but the previous guidance was that the PATMI will be slightly lower year-on-year. So now they just shifted it to the top line and said that it will be around 2025 levels. And that's assuming, of course, we don't get any more rate cuts and that the SORA will come in around 1%. So the other guidance for like non-interest income is still high single digits. CIR or cost to income ratio has no change. And also the specific provisions will still be around 17 to 20 basis points. So if you put all that in and you work the numbers, we believe that there will be an uptick or an increase in the bottom line point, PATMI. It will be not very high, but we're still looking at around a low single digit kind of increase in the PATMI for FY26. Yeah, so all that being said, we do maintain and accumulate, but we do inch up the target price to $61, mainly from raising our earnings estimates for FY26 by 1% from the higher wealth management estimates. We still expect that non-interest income will be the primary growth driver, with bank assurance also providing some diversification to investment-linked wealth management fees. And also the improving Hong Kong CRE conditions do give some optionality and also some potential for GP writebacks. Considering that they have around $2.4 billion worth of this management overlay. We also continue to prefer DBS, right? Although the other two banks haven't really released their results. The main reason why we like DBS amongst the three Singapore banks is because of the capital return plans. They have given very clear capital return plans all the way until FY27, and most of it is actually going into the special dividend or the capital return dividend, right, of 15 cents per quarter. And this will last all the way until the end of 2027. They also have a fixed dividend per share policy, right? It's not based on like this floating rate of 50% payout ratio or 60% payout ratio, right? So even if earnings do take a hit, we will still see them paying very consistent dividends and dividend yield as well. Yeah, so this is the main reason why we like DBS. Next slide, please. Yeah, so we'll just be going through the Singapore Weekly. So Paul's not around, so I'm doing it this week. Yeah, so hopefully it's hopefully just as good as Paul's one. Yeah, so for the macro last week, right? The last week's data did show us quite a clear story. That Singapore's economy is firing on all cylinders, mainly thanks to the semicon cycle. And whereas the US, showing some slight signs of stagflation, which is creeping in from the Iran war. So I think this is the first month where we can see the full impact from the Iran war. But I'll touch on Singapore first. Singapore is very strong. We are seeing industrial production, up by 10% year on year in March, and this is the fastest that it has been since December. The main standouts were really the electronics and semicons, right, which is both up around 30% year on 30%, and then also it's confirming that we are in this Godzilla semicon cycle. I think Paul talked about that last week, and Singapore will be one of the main or the most direct beneficiaries in the region. If you're looking at the manufacturing PMI, it came in around 50. It came in at 50.7. So this is the 9th straight month of expansion. Electronics PMI is also up at 51.2. So this is sort of reinforcing the same message. So basically anything above that 50 mark, we will see that it's growing. And we have seen almost nearly a year of consecutive expansion. So basically this means like, for the semicon names in Singapore, like Franken, AEM, UMS, or Micromechanics, right? This macro data that we are seeing this month is sort of validating the previous thesis that we had, this Godzilla semicon upcycle. As for the US, we are seeing some warning signs. So like Z said, the Fed has held rates, by a more hawkish tone. So we also don't expect any rate cuts soon, right? But consumer confidence has ticked up slightly to about 92.8, on the ceasefire in Iran, hoping that it will come through. PC inflation is at 4.5%, up from 2.9% the prior month. Core PC also jumped, from 2.7 to 4.3%. This is really the energy shock from the Iran war and the Middle East conflict that we are seeing that is passing through. Finally, we are seeing it pass through to the consumers. The GDP for the first quarter came in at 2%, so it's still quite decent, but slowing down. And also, combined with the rising inflation, this is the sort of the beginning of the stagflation that we are seeing. The ISM manufacturing prices have also been rising at the fastest pace since April of 2022. And companies, what this means is that companies are paying more for inputs, and we believe that it will hit margins a bit. So all in, what it means that the higher for longer rates have been more or less confirmed, right? So we are saying that this will be good for Singapore banks because they earn more on deposits, but it might not be as beneficial for the REITs because their borrowing costs are elevated. Now, moving on to the next slide, we'll be looking at our technical views for the following week, or at least for this week. Yeah, so two big events, did drive our views this week. Firstly, DBS has kicked off the banking season, and also the hyperscaler capex. So first on DBS, right? I spoke a bit about it earlier, but the key points I'd like to bring your attention to would be the upgraded guidance, right? They did say that they have now, went from slightly below 2025 to now close to 2025 or around 2025. The CEO also said that the rate headwinds are now largely mitigated, right? So what this means is that the largest bank in Singapore says that the worst of the rate cut pressure on the bank earnings is sort of behind us. And then we're also seeing wealth management fees hit a record, and a lot of the flight to safety driving wealthy clients into Singapore is also pushing the Singapore dollar higher, and it's basically bringing more assets into DBS. I think there are also some questions that I've seen on the Q&A, asking about, so what do we expect for UOB and OCBC, which are set to release their results on 7th and 8th May respectively. Basically, we would expect them to follow a very similar template, as to what DBS has set the precedence for, right? Where we will see that there will be NIM compression, but it will be offset by good and healthy and hopefully record numbers in wealth and trading income. So we could also potentially see that both banks could possibly raise their guidance and maybe have some kind of step up in dividends or buybacks. I think more importantly, it will be OCBC, right? We could see them give some color or guidance on where are they going to spend that excess capital that they have. For UOB, not so much so, because they have already planned out how much they're going to give back, and based on the calculations that we did, it will actually reach. They will be able to roughly reach around their optimal CET1 level. But for OCBC, even though let's say they did all their share buybacks, and finish their capital return plan, I don't think they will not be able to reach that capital, the optimal CET1 of like 14 to 14.5%. I think they will still be quite far off. They will still have about $1 billion left in excess capital. So I think some indication of where they will go from that what they will do with that will be very good. So the second topic that we like to bring the attention to would be, and what really happened, is the hyperscaler capex shock. So the hyperscalers we refer to are the 4 biggest cloud companies. We're looking at like Amazon, Microsoft, Alphabet, and Meta. So they did, after what they released last week, right? They have collectively raised their 2026 capex from $650 billion to $710 billion. So there's an extra $60 billion that is coming into the system, and just basically 1 quarter of earnings results, they just raised it 60 billion. So if you look at it, everything added together, 710 billion in total. Just to put it in some way to compare, right? It's about 1.5 times of Singapore's GDP, right? And the market reaction for this was quite split. Alphabet did rally a bit, because they showed that AI is driving their revenue. Whereas Microsoft, Meta, and Amazon, they did sell off because they are worried that their spending is running ahead of their revenue. So they're spending more than their revenue is actually growing. So the market has basically reacted and said that it will tolerate big capex spending only if they can see that the payoff is coming. And what we can take from this is, for Singapore, is quite a positive, because this extra 60 billion that they're spending will flow directly into the semicon supply chain. We're looking at like chips, equipment, components, and the 4 names that I mentioned before, right, for the Singapore would be like Franken, AEM, UMS, Micromechanics. They all sell into this ecosystem, so they will be more or less direct beneficiaries of this uptick in capex. For the other one that is a bit more maybe under the radar would be Sembcorp Industries, because data centers do need a lot of huge amounts of power and cooling, right? So we are seeing that the US power grid is a bit strained, and Sembcorp's gas trading and also their renewables business is positioned to benefit more indirectly from this same trend. Yeah, for the weeks ahead, we are looking at the Singapore retail sales, the US ISM services, and also the job openings. So we would like to watch this US data quite closely. If the services prices follows the good prices higher, then the Fed might be more boxed in to do some rate on the rate cuts. Also, AMD is releasing their results on 6 May, and this is will be the key to our semicon thesis, right? So if they confirm that they have very strong AI chip demand, that will be another basically tick in the box for the supply chain trade. And also, like I mentioned, UOB and OCBC on 7 and 8 May, and also the US non-farm payrolls. which will show whether or not the US labor market, how is it performing under this inflation pressure. We also have our corporate insights webinar. So for this week, we only have Manulife US REIT on 7th May, and then the following week, we have Capital Infrastructure, and also Centurion, Oxpay, and AMZN. Yeah, so I think that's all we have. We'll just jump straight to the Q&A. Yeah, let me just go straight to the Q&A. Yeah, I think I answered quite a few questions already on the banks and like what do we have the outlook for OCBC and UOB. There's one here. Do you see capital inflow from UAE ultra high net worth family offices coming to Singapore and hence benefit the Singapore banks? If yes, which banks will benefit the most? Yeah, so from DBS, they said that, what we believe also is that the deposits growth hasn't really spiked up, right? It has definitely continued to increase, but I don't think, and also capital inflow hasn't really spiked up because of the whole Middle East conflict. I think one of the reasons was that maybe it's too far away, and Singapore is a bit too far away from UAE and the Middle East for them to actually get a lot of this money come in, right? So I doubt we will see huge capital inflows, and if any bank that will benefit the most from this, I think it would be DBS, because let's say if the tables are turned and you are a Singaporean or someone in Asia looking to put money, or you want to go to US, right? You'll be more familiar with the bigger names, right? And the bigger name there will be like JP Morgan. Same here story in Singapore, where you look at the bigger names, right? You want to put in the biggest bank, right? I guess the most trustworthy bank in their eyes, and that will be DBS, because they have the most presence in Singapore and also the largest assets and largest deposit base. So I guess if there will be any benefit from the capital inflow from the Middle East conflict, that will be benefiting DBS the most. And they're also the most global compared to the other two who are more ASEAN and Asian kind of base. And then now, if you look at OCBC, they're also trying to become more of an ASEAN bank, right? Instead of like just northern Greater China. Yeah, so I think DBS will stand to benefit the most from this. Yeah, you're right. So Ian also asked, perhaps capital inflows from UAE will benefit the foreign banks with branches in Singapore. Yeah, I would think so, definitely. It'll be a lot easier, I guess, if you want to transfer your money. Let's say if you have it in Citibank or HSBC, right? You want to transfer it to Singapore, then that would benefit them. Yeah, but we only cover the Singapore banks, because otherwise, can only speak on the Singapore banks. I think there's one question here on Yangtze. Let me try to find it. Sorry. Yeah, I think it's Yangtze Maritime. Yeah, asking why is Yangtze Maritime expanding its new build portfolio? Yeah, so for this, there are 4 key reasons. Right? The first one is the cost advantage, which is coming at the right time. Because they do partner with Chinese shipyards, and now that tanker prices are at like 15-year highs, right? This is one of our investment theses actually for Yangtze Maritime. So they're actually locking in the attractive price, which can later be unlocked for like either through resale or chartering. The second one is that they do have multiple ways to make money. That's also another investment thesis that we have, right? We keep talking about the full life cycle of how Yangtze captures the full life cycle of the ship. So they can, for a new build, right, it can be pre-sold for capital gains. They did that with 4 MR tankers in April. Also, it can be chartered out for recurring income or can be financed via sale and leaseback. So this flexibility is very good for them. So actually doing this is very good. Also the third one would be riding strong tailwinds, right? The Middle East conflict and the Strait of Hormuz disruption are pushing the tanker demand higher. And last but not least, and also linked to another thesis that we have, is that they're actually putting their cash to work. So what they were previously is they were more of a cash management company, right? They had like few hundred million sitting in like fixed deposits and government securities. That earns them, in this environment, barely 1 or 2% if they're lucky, right? So now they have around $400 million of cash, right, sitting in this low yield securities and deposits. So if they are deploying it into these maritime assets, it will actually give them about 10 to 15% of returns. And if they use leverage, even more so, you will double to 20 to 30%, right? So this basically is capturing more value for the shareholders and investors. Yeah. So overall, that's their whole business. Their aim is now to make use of their cash better to gain a better yield basically on the cash. Yeah. Let me just look through again to see whether I got any more questions. Yeah, about iFast, why iFast share price dropped? Yeah, a bit hard to say. They did have a bumper quarter. I guess maybe it's a bit because they are now looking at a more longer term kind of they're giving a bit more. They give a lot more detail, right, into where they want to see each segment grow, right? They always talk about this 100 billion kind of AUM, right? But they never gave the breakdown because we don't know where this 100 billion is coming from. So now that they gave this 100 billion, I think it's a bit more clear, and also, it might be a bit hard to reach, especially for the global bank, right? Because they're looking at like close to 50% or 40% kind of CAGR over the 5 year. I think it's a 5-year CAGR. Yeah, so it is a bit, maybe it's a bit unreachable, right? It's a bit of a big goal for them. So, and they're not showing that, like, the growth in the global bank is still very slow. I mean, look at the absolute numbers, it's not as fast as you would expect it to be. So I guess that would be one of the main reasons. Yeah, I answered the one about I gave the view on Yangtze Maritime. Okay, see whether I got any more. Yeah, about the Yangtze financials. Yeah, they have very high NPL because it's all Chinese properties, which is why we don't. But we are not right. We don't really like it. Yeah, because of the super high NPL ratio. I think one of the highest, and it's still now even more so, right? They take out the maritime one to split it up. I guess that's a good move on their part, so they are taking out maritime because otherwise, you can see that this Chinese property investments, right, actually was pulling down Yangtze Financial Holdings, right? Because they had it both, right? Previously, Yangtze Maritime and Yangtze Financial Holdings were together. Then now they split it up. So, right, they really moved out that maritime portion, which is, I guess, a very good thing. Yeah. Yeah, okay, maybe I hand it over. We have quite a lot of questions. So I'll hand it over to the rest of my colleagues first. Thanks.
I guess I'll take some question first. So hi Helena, why did Apple rally after results despite citing memory constraints? So the Apple results, Apple report is actually going to come out today afternoon, but I'm just going to comment on it first. Yes, the memory constraint is definitely going to be a big impact on pretty much all the phone companies. But the reason that the result was the price actually spike up was because they have very better than expected iPhone 17 cycle. So it was already better than expected in the previous quarter, and they've guided for a very positive guidance last time during their last earnings. And turns out they've beated their very positive earnings, and they've also guided for a more positive earning for the next quarter. So overall, very, very strong demand that they're seeing coming from iPhone, and strength across all regions, is even in China, where the market has been very muted for multiple years. And right now, iPhone 17 is supply constrained. So if there's no constraint, it's actually even going to do better. And not just the iPhone, they're also seeing very strong demand in their MacBook, especially the MacBook Neo, because of the very attractive pricing. So overall, it's because of that. And I think another reason is because it's a very tech-heavy earnings week. And all the other competitors are talking about they're doubling down on their capex. So Apple, in comparison, they're very AI investment light. So they're really choosing like a different trajectory. So I think that also caters to some people who's really thinking that currently people are really spending too much on capex. So I hope that answers your question. And I saw another question on Netflix and Spotify. So between Netflix and Spotify, which is the better stock driven by a stronger growth and potential? Because you do see some similarities and modes, and you're most definitely right. I think they're in very similar position. So both of them are the clear market leader, so they don't have a very, very close competitor, and they monetize it so much better than their competitors. But I guess position-wise, Netflix would be in a more mature position compared to Spotify because they already have higher quality growth and strong monetization. It's a more safer compound when it compares to Spotify. So Spotify is still in a more earlier stage of monetization. Yes, they're still clearly the leader in the industry, but they have more, I think, a little bit higher risk because you can see Netflix, they've actually increased their price multiple times, and each time the hike was fully absorbed. And they're expanding their ad sector very, very aggressively. Well, on the Spotify side, they're also raising price and they're also doing okay. But the reason prime they increased the price, we can see that actually the premium side didn't really increase that much. So I would say the price absorbing power between Netflix and Spotify. So Netflix would be relatively stronger. And Netflix is they're monetizing their entire system so well, they're already considering to expand the reach out, which is why they were looking at the Warner Brothers deals. So even when it didn't go through, it kind of show you that Netflix, they're already doing everything that they can, and they're looking to expand in other ways. But I think the only reason that we always have a lower recommendation for Netflix compared to Spotify is because Netflix price itself is already really high. So the market has already priced in like all the benefits. So it really depends on what's your trading objective. So if you're looking for a better stock, a more mature, stable stock, I would definitely say Netflix. But the price itself is already pretty high. So yeah, I hope that answers your question. I think that's pretty much it. Let me just go through it. Oh, there's another Netflix question. How do you evaluate whether Netflix ad-supported tier is truly incremental ARPU accretive versus being a downsell from premium subscribers? And what data would change your current assumption? Well, Netflix is actually expanding its ad-supported tier very aggressively recently, and they've doubled it in the last year, and they have the goal to double it again. I would definitely say it works very well in terms of getting new users coming onto the platform, but I wouldn't say it's a downsell from premium subscribers because their ad sector is doing so well right now. So for some users who are not frequent users, they've actually automatically changed you from a premium subscriber to an ad supported tier because they realize that if you watch ad, so the money that helps them to earn is actually higher than you paying them the premium subscription. So for those users, unless you opt to pay for the premium subscription again, they will just default change it to ad supported tier. So that definitely is how the ad supported tier is already bringing in more money compared to the premium side. So yeah, I wouldn't say it was a downsell from the premium subscribers. I guess that's all from my side. Pass it to my colleagues first. Thank you.
Yeah, thanks, Helena. I'll take on quite a lot of questions. Has Aztec turned around? Results look good compared to a year ago. Yeah, I think you're right. The revenue has grew by 54% year on year, and they also announced that they secured 6 project orders and also added 2 new customers in the security and renewable energy space. Yeah, so I mean we don't cover Aztec, but I think directionally is turning around. Yeah. Why did Qualcomm surge so much recently? Yeah, so on 30th April, I think it was their earnings call. They mentioned that they will ship custom AI solutions to their hyperscaler customers by the end of this year. So they brought forward the timeline. Previously, their guidance was next year. So they brought forward, and they are also trying to enter this custom AI space. Yeah, so I think that's what got investors hyped up for Qualcomm. What's the difference between Micron and SanDisk? Yeah, so for Micron, they are more involved in the high bandwidth memory space. So high bandwidth memory is basically the chip that the most high-end GPU and CPU will need in order to work together. For you can think of it as NVIDIA's GPU racks or AMD's GPU racks. So both of these need high bandwidth memory, and that's where Micron will supply the memory chips. Whereas for SanDisk, it's more of a solid state drive, NAND kind of solutions. So solid state drive, you can think of it as your thumb drive, your hard disk drive at home, where they don't need electricity for the memory to run. You can unplug your device and the memory will still be stored there. Yeah, so there's optimism around that area also, because data will also need to be stored in standby before it's being fed to the high bandwidth memory space, where the parallel workloads are working together for the AI workloads. Yeah, so I think hopefully that answers your question. Yeah. Why didn't NVIDIA rise after increasing capex by hyperscalers? Okay, so my thoughts is that a lot of their growth prospects is being priced in already. So because I think hyperscalers at the start of this year, first quarter, they already announced that the capex will be accelerating compared to last year. So I think a lot of people priced this in already. People are expecting that hyperscalers will increase their capex. If going forward, I think the main catalyst for NVIDIA stock will be either maybe there may be more sovereign investments coming in, maybe from Middle East, Europe, or Asia, whereby the sovereign countries will want to build up their AI data center. That may drive some catalyst for NVIDIA stock price. Either that or NVIDIA may be entering the custom AI chip space after their $2 billion acquisition of Marvell. So that may also be a catalyst if they were to enter the custom AI space. Yeah. What do I make of AMD's results this week? I think they'll do well. Currently, AMD is still gaining PC market share from Intel. So even though Intel mentioned that the PC market will soften in demand, I think PC market will at least remain flat for AMD. Whereas the entire CPU market is expected to increase because of the transition to agentic AI workloads. So because of this transition from previously it was training for the AI workloads, now they transition to inference and agentic. There's a much greater demand for CPU. So I think that will be a tailwind for AMD. And also AMD is coming up with the next generation MI450 GPU by the end of this year. So that will also be a share price driver. Yeah. How's Micromechanics results? What is their business model? Yeah, so I think they did well, their results. Is year-on-year wise, I can't really remember the exact figures, but I remember it improved from the previous quarter. Their business model is that they are a component supplier to their major customers, which are memory players, and also advanced packaging customers. So you can think of it as your semicon equipment players as well as memory players. Yeah, so they mentioned that they supply critical parts for the chambers, and yeah, and they also serve memory customers. I think they are slowly trying to pivot into the front end space. Traditionally, they have been more in the tooling side, so they supply the tools for the circuit boards used in semiconductor. Yeah, so that's for Micromechanics. SoyBuild, my views on current price and its target price. Yeah, so SoyBuild's price is around $1. Our target price currently is 140. I think SoyBuild generally because it's in the construction sector in Singapore, generally that's a tailwind, and also because it has a track record in semiconductor high-end facilities. For example, the Soitec facility that they have completed. So generally I am positive on SoyBuild, but I would think that a potential headwind for SoyBuild is that most of its order book come from the private sector. And I think we are seeing a bit of a softening demand from the private sector because of the Middle East conflict. Yeah, so that may be a potential tailwind for them. Yeah, and previously the Tuas Port contract which they secured is an exceptionally high, it's an exceptional order, so about 600 plus million. But typically they secure orders ranging from 200 to 300 million. So we do think that the order book will normalize down to about 7 to 800 million, yeah, going forward. But currently their valuations are still very healthy. They are trading about 9 times PE, whereas the construction sector average is about 14 times. Yeah. Okay, I think I handle. Oh, okay, sorry. I think I see one. What's my fundamental analysis on the new DRAM ETF, Long Hill Memory ETF? Yeah, sorry, we don't directly cover this ETF, but I took a brief look at the components within the ETF. I think it's split 20% between the three biggest memory players, Micron, SK Hynix, and Samsung. So I think if you really want exposure to this ETF, it's a good entry into the memory players. And currently memory is in an upcycle because of the shortage. I do think that the shortage will last till second half of next year itself, because globally the capacity which are coming up this year will be SK Hynix and N15X fab. So it's a huge fab by SK Hynix that will come up this year. But for Micron and Samsung, there won't be any capacity coming up this year. Their capacity will only come online next year. So I do think that the shortage crunch will last till the second half of next year. Yeah, which will be positive for this ETF. Yeah. But it's not a diversified play. If you play this ETF means you're quite purely into the memory sector only. Yeah. I think I'll hand over the time to my other colleagues. Yeah, thanks.
Let me take some question. So first is for Microsoft. So why is the recent result beats in the explanation of the price down, unlike the other emissions up? So Microsoft made the result both by the revenue and the earnings, but I think the market is focused on inflation. The big negative is that because the big negative is that our the overperformance in the race in the CapEx category. So it's not the big revenues, but the CapEx race in guidance is large. So the raise the CapEx as previously mentioned from 160 million to now 190 million for 2026. So following the raise in CapEx, the quality of the cash flow later, it means that if you look at the operating cash flow growth for 2026 now slow, about 1% lower from 27 to 26%. And also the change in the net cash is now expected to turn negative for the financial year of 2026. But regardless, we think there's still sufficient operating cash flow this year to cover the capital expenditure. And one thing is also looking at the content for the REITs. We think Alphabet is doing better. While product is still annual value margin, but the RGU margin is reduced slightly. And we expect obviously to remain margin negative in the near term. Positive scenario might be in the 2027, and there's meaningful revenue recognition from open AI to this platform. Increase the revenue, then they might see a segment from Azure margin to turn higher. So next is on percent review and balances without tomorrow. For first quarter, we expect plenty good revenue for like 74%. I think there's still upside potential for upside stemming. Growth will be driven primarily by commercial segment, but many in invest region, where in previous quarter, commercial revenue we expected to about 7% launch. And we think there's still possibility of stronger revenue recognition because in the previous quarter, the commercial total contract value have accelerated, and in the previous quarter it grew by 9.61%. With that in mind, we think that there's still possible revenue overperformance in this quarter. Yeah, the plans also being set on potential for higher forward guidance. And we still think that overall quality will continue to benefit from the rising AI demand driven by this AI platform. Valuation wise, as we said, the business of Poland is quite straightforward that the buyer group is quite they are few they are you wouldn't really be able to find any companies in the large revenues sector that grew about 60% away their revenue. So as long as the growth still sustained, that's what they can get and market take. And yeah, the valuation is biggest all time. Next on which stocks are exposed to OpenAI recently regulated user target. So almost every large cap tech companies in the industry, especially the cloud industry on this industry, have exposure to OpenAI. But the largest would be Microsoft Cloud because of the fifth group order from cloud services. Previously, they mentioned about 1.4 trillion in commitment. So the most important is that we believe OpenAI could pay off their commitment as represented in the assessment. We think their business, for example, the subscription to API for model is small, the business-wise, compared to the amount that they need to pay off the facility. The biggest portion we think would come from the capital market instead. So OpenAI may survive based on the capital market instead of just their own business alone. So hence less than all the less user targets and so on. Because see, even if previously they were able to raise about 102 billion from the market capital market. So the focus is on the OpenAI is that the IPO date, which is not yet confirmed, but we think this probably will be the late 2026 or earlier of 2027. So this all for me. I will pass over to my colleague. Thank you.
Yeah, sorry for the audio. Yeah, let me try to answer some. Your view on Stoneweg and comments on its potential to grow as a DC provider. Yeah, so actually I went through that during my presentation, but generally we think currently Stoneweg has about 7.2% exposure of their AUM in data centers. So going forward, they have a target to bring it to 15 to 25%. So they can do it through a few ways. So either divesting non-core assets, so that's one. But more specifically, they are looking to either invest more into the sponsors data center development platform through Ionic. So that's another one, and potential conversion of over 10 of their logistics properties. So they are doing like initial studies and such on those assets. So for that, if you convert, usually the valuation can go up to 3 times as compared to a logistics property for a data center as compared to a logistics property. Yeah, so there is a lot of upside potential for that. With the divestment of Indonesia's portfolio pending, first REIT dividend yield is expected to decline. What is the reason to continue to hold this stock compared to other larger? Yeah, so that you're exactly right. So that's exactly why we also downgraded our target price. So previously it was 29 cents. So now we just drop it all the way to 25. So 25 cents. So we're trading at around book. Yeah, because of like I also mentioned, the fact that their DPU will likely drop to if I remember correctly, I estimated 1.6 cents with the completion of the first divestment. So that's a huge DPU drop. But we are still monitoring to see what they'll acquire. So it is still quite uncertain. So which is why we also valued it at one time its book. Yeah. Yeah. So what's the reason basically to hold this stock? Yeah, it is risky. We wouldn't if we are not an investor, it is I mean we do have a accumulate call for now, which is tagged to one times book, like I said. But the outlook is still quite unclear for First REIT generally. Yeah, because we don't know what they are going to acquire. Yeah, so that's the for First REIT. the trading for Stoneweg, the trading liquidity is already low. Wouldn't share buybacks further aggravate this situation? Yeah, that's exactly right. You're exactly right, CK. Low liquidity will discourage institute from participating in this REIT, hence preventing unit price from appreciating strongly. Unlike capital district and CSD. Yeah, you're exactly right. So we did flag it out to management, but management view is that they did have some excess liquidity, and as well as the fact that their share price was really dropping to a range where they felt that it was the best option for them to buy back. So they are also monitoring, and they will not do it in large quantities. So they're doing it bit by bit, so as not to really aggregate the fact that the free float will be less and lesser, will keep decreasing as they buy back shares. So they are wary of that also, and we don't think their intention is really to buy back that. It's really to buy back to sustain the share price. But over time, we still we don't think this will be a significant issue, as we doubt that they will continue to buy back significant amounts. Like with the management is aware of this. Yeah. So you don't think going forward it's likely that they'll continue to buy back a large amount, as you think it's more likely that they'll use the proceeds to source for more accretive acquisitions. Yeah, that's our view. Yeah, but right, you're exactly right. If they keep continue to buy back, then definitely their flow will continue to be lower, and that might prevent or rather discourage institutes from participating. How much of Ascott's assets are in US, and how much uplift can we expect from the upcoming World Cup? Yeah, so I estimate that for uplift for US portfolio itself, probably 40% uplift easily during the period. But for CapitaLand Ascott's assets in the US, it contributes almost 20% of their portfolio. Yeah, but a portion of it is also the USP BSAs. Yeah, so with the still weak retail property setting in China, why would CLI want to launch another C-REIT IPO? Yeah, so actually for the local C-REIT demand is very strong. So you've seen from the first C-REIT, the share price has performed very, very well. And there is a lot of local demand in like China capital that is into the C-REIT. So which is why they're also looking to launch this second C-REIT. But this second C-REIT will be a larger mandate that includes integrated developments as well. So which is why they're going to see it with first City Shenzhen and Capital Mall of Fucheng. So this basically is an expanded mandate from the previous first C-REIT that they did. Yeah, so and also with this C-REIT, they also can it's easier for them to monetize. So for the first C-REIT, if I remember correctly off the top of my head, they had a 1 year period where they couldn't inject more assets into the REIT. But for this second C-REIT, they do not have this restriction, so they have the opportunity to really utilize this as a capital recycling tool. Yeah, so that's why this second C-REIT is a positive. But overall, in the longer term, because of this expanded mandate, we do believe it's their goal to merge the first and second C-REIT together with this expanded mandate. Yeah. For Migochi Industrial, why is the USDC portfolio a drag when AI and cloud storage are the high demand? Yeah, so for the US portfolio, their data center, a lot of it doesn't it's more for caters to enterprise users and not so much AI and cloud storage, so which is why the demand is lower. Yeah, so that's why the US data center portfolio is more of a drag, and they are looking to divest that and redeploy into assets in better data centers where they can support AI and cloud storage workloads and such. Any thoughts when the impact of high oil price potential for high longer rates start to trickle into the properties owned by the REITs? If yes, which REITs will be able to withstand, which REITs are vulnerable? Yeah, so so far for first quarter results, most of the REITs, they have indicated that they really have minimal exposure from this higher oil prices and higher electricity, mainly because either it's fully passed through to tenants, the higher energy or electricity costs, either that or they have already hedged or fully fixed until at least the end of 2026. So that is for most of the REITs so far. But for potential for higher and longer interest rates, yeah, definitely all of the REITs will be impacted. Yeah, if interest rates stay high for longer, then definitely the interest cost might be impacted as well, and we might see some DPU decline. But as of now, assuming everything remains at current level for interest rates and such, we're still looking at about 3% DPU growth year on year. So it's still not too bad. Yeah, originally we were looking at about 4%, but because of recent developments, our numbers were trimmed. So 3% like from slightly higher energy costs, even though like most REITs also don't have much exposure, and as well as high interest rates. What's the house view on the fair price for Phillip on the ground counters presented? Yeah, so for Phillip on the ground counters is we do not cover, so we do not have a target price. So when we do Phillip on the ground, we share what happened. We try to share what happened with the counter that we have on Phillip on the ground, as well as share our view. But we do not have a target price because we do not cover those stocks. Yeah, but we try to share our view on that company as much as we can. Yeah, Parkway Life REIT recently reported year-on-year DPU growth of 15%. Can we expect the same quantum of growth for the rest of the quarters this year? How bad will the nursing homes in Japan impact DPU growth? Yeah, so because they repriced their Singapore leases and it started this year. So as a result, the growth of 15% was generated from that Singapore side, very strong rental growth. But for Japan, because of some the tenant vacate 5 nursing homes because of some financial struggles. But the increase in rents from the Singapore portfolio will more than offset this downtime in the Japan rental homes for these 5 nursing homes that the tenant vacated. Yeah, so going forward, because we still think there are many operators that are still doing good in Japan for the nursing home. So we think that they will be able to backfill those spaces in due time, but there might be some downtime. But we are looking at still possibly double-digit DPU growth for this year as well, because mainly supported by the Singapore side. Yeah. CLI has a buy rating and a channel operation is already going through challenging phase. Can you explain what will be the impact performance with the launch? Yeah, I think I went through that roughly already. So they'll continue to divest, reduce their balance sheet in the China assets and move it towards the second C REIT. Yeah. Yeah, so for that, we're also expecting the REIB business to continue to decline. But that will be offset by a stronger fee-related business, like we saw in the first quarter. So kind of similar numbers, lower REIB, but FRB, we're looking at least a mid-single-digit growth as a whole for this year. Yeah, possibly even more from the event-driven fees from the listed side. Yeah, that's coming up. Now, once complete, we are looking at just the CICT itself. I mentioned about the CICT2 transactions. We're looking at about over 50 million in fees, event-driven fees. Yeah, still many questions. Almost out of time. I think possibly I hand over to Zane for the TAs. Yeah, thanks.
Yeah, thanks, Darren. I'll move on to the key questions. Yeah, so first question on Singtel. I think there's likely to be some stabilization in the share price. Last week it hit a 200-day moving average over here at around 450, which is this purple line. And I think also we're seeing some reduction in terms of volume peak over here as well. So this bullish candle was accompanied with quite relative high volume as well. And today we are seeing a further rebound towards the 10 MA currently, which is around 468. So I think there might be some resistance, but I think price will likely do a bit of a stabilization with support around 460, and then maybe some further rebound towards 473 next as the next resistance, which was previously this breakdown 22nd April. So I think likely to be some stabilization for Singtel share price. Next question on Capital DC REIT. Yeah, for Capital DC REIT, I think price likely to do a bit of a sideways. During the pullback on Thursday, I think continue to find support at $2.32 to $2.33, which is quite important. Previous resistance, horizontal resistance, as well as this recent swing low at the 20 MA as well. So there will be a rebound. I think near-term resistance we are likely to see 237. Over here still do a bit of resistance. And then next one is like 240 to 242 area. So overall, I think price is likely to do a range consolidation. Finding with support at the lower end at 232 over here and the resistance at 242. And next one on Aztec Global. Yeah, so the share price has rallied quite a bit recently. I think it's likely to do some consolidation after such a strong run, hitting 104 resistance, tested 2 days, but still managed to hold resistance. Today we are seeing a bit of a pullback. So I think near-term support likely to be around the 5 MA, which is around 95 cents for now. And then afterwards, you might see some sideways price action afterwards. Above 104, I think the next resistance likely to be at 108 as well as 112, given the previous levels. Then there's a question on Toku. Yeah, for Toku, I think share price is still pretty much sideways since mid-February. The key resistance is still above from about 25 cents to 27 cents area. Positive thing recently is that this could be the recent dip over here at 23, about 23.5 cents could be a bit of a higher low. Given this was a bit of resistance over here at 23 cents and it was a breakout on high volume on 16 April over here. So if this holds, we might see a lower high build over here with resistance likely to be around 24.5 to 25 cents in the near term. So it could be a bit still quite sideways over here. And the weekly chart, I think, is a bit clearer. So price tried to break above this 23.5 cents area, which is as well as the 5 and 10 MA on the weekly chart, and did a back test on lower volume last week. So if you can hold 23.5 cents over here this week, I think that will be a positive going forward. For now, still need to see whether you can hold this level. Okay, next question for Capital. Yeah, for Capital, I think share price has pulled back quite a bit recently. Dip towards near the oversold area. RSI was about 29 last week. So I think over here we might see some kind of sideways for the share price. As this area previously was a bit of resistance back in January to February this year. So there was around 1070 to 1090 this area. So I think price will do a bit of a sideways over here. Resistance for probably $11 to about 11.20 in the short term. Okay, next one, some of the US counters. Yeah, so first one for MasterCard, I think for MasterCard after the earnings, I think there was a bit of a gap down over here. So previously was hitting retesting this resistance area at 525. And then so the earnings we are seeing some weakness with resistance coming in at the short-term moving averages 508 about there. So I think in terms of the short-term wise, we could still see some weakness to retest this support area over here 480 to 490. And I think this will still hold as support and resistance above about 500 to about 508 for now. So probably a sideways consolidation. And then for Visa, it's a bit stronger. Visa, there was a gap up after the earnings. Still facing resistance over here, 337, this area. There was a bit of pullback, but I think price will likely to hold at this if it does retest the 5 MA level, as well as some of the swing highs over here previously at around 324, 325 area. So I think price will likely do a bit of a dip and find support over here. Then some near-term resistance is around 334 level, then followed by the high last week at 341. Next one, some of the Mac 7 stocks. First one on Meta. Yeah, Meta after earnings, we had a dip over here. I think is still holding this one support level over here. It's around 600. So I think that's still holding the price. And near-term resistance could be around 630 for Meta. Yeah. So we could see a bit of a kind of sideways price action as long as 600 continue to hold support. Below that, the next level is around 580. Yeah, then next one for Microsoft, after earnings, we had a dip towards at this level, still retesting this previous horizontal resistance at 407 as well as 28-day MA, which managed to hold with a lower wick over here. And the following day on Friday, it rebounded. So I think it's still in terms of the recent price action, it's still holding this range that we are seeing over here. So which is largely between 400 to about 430. So I think still in this range. Short-term resistance, I think it could, if it does a bit of rebound, I think we still like to face some resistance at 420 about there. In terms of the weekly chart, I think it's still maintaining okay. Recently, it's testing this weekly 20 MA 3 weeks in a row, but still trying to do a bit of a rebound over here after it's breaking above the 5 MA on the weekly chart, and it's still holding a support last week at 401. So most likely, I think it's still a bit of a range bound for now, unless it breaks below the Thursday swing low last week. And for NVIDIA, I think is after retesting the 212 level, seeing some resistance or at the double top and some weakness where price is below this 203 level last week. Is holding on Friday, is holding the 197, the 20 MA level. Yeah, so I think this is a quite important support. Price might do a bit of a rebound over here. Yeah, I think will still be quite weak in terms of the price action for now. With resistance likely to be above 203 and above. In terms of the weekly chart, could see some support from if it does retest the weekly 5 MA for a bit of a bounce. So I think this 196, 197 will still hold a bit in the short term. Now I'll take one last one on TJX, give it since it's about 1. Yeah, for TJX, in terms of the longer term trend is an uptrend over here, quite steady uptrend channel. Recently, since August last year, price has been trading at the upper end of this channel. I think could draw 2 more trend lines over here. So still relatively stable over here. Recently, it looks like a range bound, I feel. So price is still mainly facing resistance at 162. And a key strong support is probably around 152 over here, where there's a horizontal level as well as this trend line support as well. And yeah, most recent price action, I think nothing too much going on. A bit of a breakdown at 158. There's a bit of a short-term resistance over there. Yeah, then below that, support likely to go at 154 as well as 152. So still kind of sideways for in the short term, I feel. Yeah, so I think that's all for the TA questions. It's about 1. There's still quite a bit of questions that I think sorry I'm unable to answer in view of time. But feel free to post in our Poems 3 community group and we'll take it over there. Yeah. On behalf of my team, I'd just like to thank everyone for joining our webinar today and for all your questions. If you're interested, this week we have Manulife US REIT on Thursday noon time for our Corporate Insights webinar. So if you're interested, feel free to dial in. And I think that's all for today and hope to see you all again next week. Have a good week ahead. Bye-bye.